All right, we're going to go ahead and get started. So thank you so much for those that have joined and for those that are watching this after I'm recording. My name is Rick Bennett with Movement Mortgage, Bennett Home Loan Team. Also joined by who's one of our participants, Madison Thayer, one of my team members as well too. So it's been a crazy week. You've been, unless you've been living under a rock, you already know this. And so it's been an interesting time for us in the mortgage market, obviously. There's a lot of uncertainty as to what's going on. We're watching the headlines, the tariff talks and all that stuff like that. So I wanted to be able to provide you guys with my perspective on what's going on and how we can be the purveyors of truth and knowledge to our buyers and sellers that are out there right now. Because if all they're doing is following news headlines, they might have this doomsday perspective, and that's simply not the case. There's uncertainty, but it's not the end of the world. So again, yeah, the point here is just to calm fears, navigate through this, and find opportunities to help our buyers and sellers still achieve their goals. And probably what I would say right now, the most important thing is to be in constant communication with our active buyers and sellers so that we can be the ones that are calming them down, providing information, and they're not just getting it from online. The majority of the financial news this week has revolved around tariffs and their potential impact on recession and inflation. The reason it's been so volatile is that there's a lot of unknowns in how all of this is actually going to affect things in the future. And our financial markets don't like uncertainty, right? Because they're looking ahead to the future to project on what is going to happen and how uh, how they trade, stocks and bonds and all these different things. And so with the uncertainty of what's going on, it's causing volatility on a day-to-day basis. So the two main things that we look for. Sorry, phone was ringing. The two main things that we watch for in the market news that comes out are jobs data and inflation. So the unemployment data and the jobs data comes out, how many new jobs were created, how many were lost, and inflation. And weaker jobs data typically helps rates, as does lower inflation. And the really tricky thing that's been going on with this is that month over month, the inflation data that we're getting is coming down. However, that's based on past data, not future data. And the reason that the lower inflation data that's been coming out isn't helping us like it normally does is because of that uncertainty in the future on what these trade talks and tariffs are actually going to do to the market. So that's kind of where things are at, and that's the really short version of it. And we don't need to get into like all the details on the actual terminology and all that stuff like that. It just basically until we see the dust settle on this, we're going to continue to see volatility in the markets and in rates. But we will have day-to-day news that's positive and will help rates. So it's going to be a day-to-day thing in a conversation with our clients. So where are rates? Obviously, you can tell that rates are up this week. We've seen almost on a daily basis since Monday, we've seen rates increase. But to take it into a bigger picture, we're still not at the highest rates that we've seen this year. And if we go back to the end of 2023, which is kind of the peak of rates that we've seen in recent history, we're still 1% lower than that mark. So there's been still a gradual decrease in rates over the last year and a half, and we're still a 0.25% lower on standard conventional rates than what we've seen at our highest point this year. So it's not the end of the world, right? We're still have been on a gradual trend down. It's just here in the last week, since Monday, we've seen a rather sharp increase from where we were previously. Um, so the biggest challenge I think here for the real estate market is not where rates are at, it's consumer sentiment. It's what is inside the heads of our buyers and sellers that is causing them to either have fears or panicking or different things like that. Our biggest challenge right now is again, as I've said before, is just being the ones that are calming them down, being the cheerleaders, the psychologists. Is probably the main thing that you guys do as agents is just how do we help our buyers and sellers to understand really what's going on and how that impacts them in the future. So this will spook some buyers. They're going to be reading the headlines and just say, well, it's not the right time for me to buy or sell. But the savvy people will see that there's still opportunity in this. We know without a doubt that real estate is still the single biggest way to build wealth in this country. And there are needs that are out there. Need-based market are things like relocations and moving, marriage, divorce, children, all those key factors in life that we know that are still going to necessitate people to want to buy and sell. And there's still opportunity that's out there. If we start to see, longer days on market, we'll talk about some of the market stats here in a second. We start to see more price reductions. We can see opportunities, and there are ways that we can combat where rates have increased from. So real briefly here, I wanted to go over some market data. You guys have access to all of this, obviously, but I thought it would be helpful to go over a little bit of it. We've had a 0.6% year-over-year increase in single-family closed sales in the Tampa Bay market. This is as of February, so it doesn't include March. That data is not available yet. Median percent of original list price at 95.6%, meaning that there's been almost a 5%, 4% and change reduction in price from the original list price, which is down 0.7% year over year. Median time to contract, 44 days. New listings are up 9% year over year, and active listings are up 35% year over year, with a monthly inventory of 3.8 months. And what NAR says is a balanced market is 5.5 months. This is for single family homes in Tampa Bay market. For condos, you guys know that the picture is not as good. Condos have been much more difficult to sell this year. Median percent of original list price is 94.4%. Months of inventory is 5.8, so it is leaning more towards a buyer's market, and active listings are up 22%. So what does all that mean for us? I think for you guys, as you guys know, you're the experts in this, I'm not, is that it takes very intentional conversations with sellers on how you price the home and what the expectation is for how long it's going to take to sell it. It's probably one of the most difficult things, I think, in your job is having those conversations with sellers and how they price the home, what they think the home should be priced at, what you're telling them the home should be priced at, and then how to then negotiate with them in terms of price reductions and other concessions that you can make to help it. So on my side, the biggest thing that we focus on is budget, not the rate. The biggest question that I hate getting is, what's today's rate? And I'm like, what do you want it to be? So I don't really say that, but that's just me being sarcastic. I'm channeling the sarcasm of one of my favorite agent friends on that one. But we focus on his budget. What is the monthly payment that you can afford, the maximum monthly payment that you're comfortable with, and how much in total funds do you have to go towards down payment and closing costs? How much do you want to invest in this purchase? That's the most common question. That's the most common statement that I make to every single buyer. Because yes, rate is important, but what that translates into is, what is the monthly payment that you can afford? And once they give me that target up front when I'm working on the pre-approval, then I can help guide them on what is the purchase price that they can actually afford. And if they do find something that's outside of their purchase price range a little bit that they absolutely love, can you increase your budget? Or can we negotiate with the seller for a seller credit to help with a rate buy down, which I'll get to in a minute here as well too. So yes, so basically once we know the buyer's target, then we can help redirect them to what is that monthly payment that can help them get into the home and whatever they're comfortable with. So I'm going to talk about a couple of strategies here that can help you guys, and we're going to keep this relatively short today because again, I just wanted to be a kind of a quick update so you know exactly what's going on in the market, what we're seeing, and what we can expect in the future. So the biggest topic we're talking about with clients in terms of helping with affordability are rate buydowns. And we have two different ways that we do that. One is a permanent rate buydown, and the other one is a temporary rate buydown. A permanent rate buydown can be achieved with the buyer's own funds or the seller's own funds, lender's funds, or a combination of all three. And this is where we get kind of real strategic in how we work on allocating funds in order to help get that monthly payment to where the buyer wants it to be at. So from a buyer's perspective, there's a limit to how much they can pay for a permanent rate buydown. And it's roughly about 2% of the loan amount. So again, it depends on the down payment amount on there, because with that limit, there's a compliance threshold on how much the buyer can pay. And there's also a question of how long they plan on being in the home for. Because if they plan, they'll say, well, I'm only stationed here for a year, and then I'm going to be, PCSing out of state, then it might not make sense for them to buy down the rate because they're not going to recoup those funds. Unless they're like, yes, I have a hard budget, I need my monthly payment here, then yes, that makes sense for them. Or if they can't qualify unless we get the monthly payment down, then that's another situation or area where we can help them with the rate buy down. So again, there's a limit to how much the buyer can pay with the rate buy down. But when the seller contributes funds, it resets that threshold. So let's say in one case that a seller is contributing $10,000 towards closing costs, prepaids, rate buy down, however you word it in the contract. We can take that entire $10,000 to apply it towards the rate buy down, and then on top of that, the buyer can chip in on it as well too. I have a situation right now, closing next week, where the seller contributed $12,000 and the buyer paid 2 points. We chipped in to help as well too, and the buyer was able to get an interest rate about 1.5% lower than current market rates, which substantially helped in their monthly payment. So in this particular buyer's case, it made sense. She plans on being in this home long term. Her most important piece is getting that monthly payment down, and she had a limited amount of funds to do with her down payment. She did 15% down. So in that particular case, it made the most sense for her to do that permanent rate buy down. And the home appraised for, I think, $5,000 over contract price. So it was a perfect scenario for her, total win-win across the board. The second piece is a temporary rate buy down. The most common one you see on here is a 2-1 or 1-0 buy down. There's also a 3-2-1, but most commonly over the last couple of years, the one that we've done is a 2-1 buy down and a 1-0 buy down. On the 2-1, that means it's a 2% lower rate the first year, 1% the second year, and then the start rate from years 3 and on. This is not an adjustable rate mortgage. A lot of people think that, is this like an ARM? No, it's not an ARM. It's a temporary buy down. And the discussion we have with the client up front is, are you comfortable with the payment in year 3? Yes, but do you want a kind of a temporary relief and ability to ease into that payment over the first 2 years? So if we've got a client that is, kind of maxed out in DTI and the monthly payment is really not going to be achievable for them, I caution them in doing that because they need to be prepared for that monthly payment in year 3. But they want to be able to ease into it. An ideal scenario would be someone that's got year-over-year increases in income. They get regular bonuses and things like that, or increases in pay. Perfect candidate for that. And when the seller pays for that 2-1 rate buy down, the funds are actually placed in a separate escrow account. And each month, the reduction in monthly payment comes from that escrow account. And if they refinance prior to the end of that temporary buy down period, they keep those funds. They're not spent like they would be upfront and non-refundable on a permanent rate buy down. So it's a great scenario that we pitch to clients that we say, if rates decrease in the next year, we can refinance you at a lower rate, and those funds can be applied towards the refinance just like they would on their escrow account for taxes and insurance. And with Movement specifically, if we refinance them, we're going to waive their lender fees. We'll be able to apply any funds from their escrow account to the new escrow account. So it ends up being kind of a win-win situation in that particular case. So those are the two most common ones on there. Well, the 1-0 buy down is just like it says, it's a 1% rate reduction for the first year. And we can, again, funded by the seller on there. So I wanted to give you a quick scenario here. I was running numbers with Madison earlier on marketing this in a listing for one of our listing agents, and with doing a 2-1 buy down on a listing, it would reduce their monthly payment by $550 the first year, $175 the second year, and then from there would be the standard start rate. And the total amount of funds that we would need from the seller is a little under $6,600. So when you're thinking about that in terms of pitching this to a seller, is that when you're looking at price reduction, seller concessions, and things like that, it actually doesn't take very much money. This was, I think, was like a $500 and something thousand dollar, $500,000 or $600,000 listing that this is on. $6,000 is on a $600,000 listing, obviously just 1%. It's a 1% concession that they're giving. It doesn't take a ton of money to be able to do this and make a significant impact. In that case, $550 a month for that. Using that same amount of money, let's say let's say they were doing 10,000, which would be more than enough for the buy down. By reducing the price by $10,000, it only made a $55 a month difference in monthly payment. So again, if we're really being conscientious on monthly payment, offering a concession towards a rate buy down is going to make a massive difference in the buyer's monthly payment, whereas a reduction in price is only going to make a very small difference in their monthly payment. So it's definitely a conversation piece to have with sellers and with buyers as well too. And the great thing about this is that we can partner together and we can market this in your listing with flyers. And we're also willing to make reverse prospecting calls on past showings and buyer agents that have sent that listing to one of their buyers and educate them on that. Combine that with price reductions is a great strategy to be able to help with affordability and help market your listings and educate your buyers on how they can negotiate with sellers to get that monthly payment that they want. Probably the most important piece, though, that I want to talk about with you guys on the agent side when it comes to marketing buy downs or concessions or with buyer agents that are trying to negotiate this with sellers is to make certain that you're negotiating this with recent comps in mind. The reason I'm saying that is because if we work up a whole perfect deal for a buyer based on receiving a certain seller credit, we get under contract, then we order the appraisal. If the appraisal comes in below what was negotiated, then it's unlikely that the seller is going to reduce the price and still offer the concession towards the rate buy down. So making sure that the home is priced appropriately and the offer you're submitting is according to current recent comps is extremely important on that piece as well too. And on the listing agent side, as you are working with a seller and you want to market a buy down in the listing, again, have that conversation with them that if you know it's overpriced to begin with, kind of have that more realistic conversation. Hey, if we're going to offer a seller credit, we probably need to do it in combination with a price reduction because I know that where comps are at right now. So again, it's a piece that you guys can navigate and I can help run numbers to show you the difference it will make on how much of a credit they're willing to give and so on and so forth. So that's the whole buy down strategy, how we approach buyers with it and how we can help our sellers to market it in their listings. Wanted to just go over a couple more strategies right now from what we're seeing in the current market. And probably one of the biggest questions we see with sellers when they go to list their home is, I'd love to buy that new home, but I need to sell my home because I need the equity to put towards down payment. And I don't want to submit a contingent offer. So how do we get around a home sale contingency? I've got 5 different strategies on that. I'm not going to go to all of them into detail, but this is a very common thing that I work with sellers on before or as they're listing their home, so we can know how to best negotiate on the new home purchase. I've also recently attended a webinar with a company that helps with eliminating contingencies for a fee as well too. So it's kind of one of those, if it makes sense type of strategy, it works. I've already had the entire scenario checked by our underwriting department to make sure that it's going to pass underwriting guidelines if they do submit an offer with this third-party service that eliminates the contingency as well too. So I've got multiple strategies on that. I work with clients on a regular basis on it, and just know that if you've got a seller that is anxious or doesn't know anything about how we navigate that process on that, get them in touch with us and we will go through all the different steps that we have to be able to avoid it. And if there simply is not a way to avoid it, then we go ahead and they submit a contingent offer on there. Other thing are on condos. We know condos are taking longer to sell and whatnot. And what we can do with you on the listing side is we can check to see if the condo is already on Fannie Mae's approved list. And if it is, all we need is master insurance. And it's a completely streamlined process from an underwriting perspective. And you can market this in the listing. Hey, this condo is already Fannie Mae approved for conventional financing with just updated master insurance policy. And you can get that policy, already have it on hand that you can provide to the lender when it comes time to get a contract in on it. If the condo is not already on the Fannie approved list, we also have the ability to pre-submit that condo to our condo department to have the condo review process started and even completed on that for you. And so if you've got a listing that's just been more difficult to sell, and you want us to kind of help with the condo approval process to help you in marketing the listing, reach out to me and we can help you with that as well too. And the last piece to talk about is that there is a growing number of homes that are active listings along the coast that have been flooded. And I think we're going to get to a point where the investor concentration for the number of those homes they're willing to buy for cash and renovate them, I think we're going to hit a little bit of a peak on that. I've talked to multiple GCs and builders in the area, and a lot of them have they said, oh, I've already got 3 of those properties already going. I can't take on another one. And so one thing that we can do to help with that are renovation loans. I've worked in the last couple of weeks, I've been communicating actively with our renovation department, our division. We have a separate division dedicated to renovation loans at our company. We do them in-house. We handle the draws in-house, all of that. And the big thing I wanted to make sure that could be done is on a conventional renovation loan called home style, you can elevate the home as part of the renovation cost. And you can do that one of two ways. One is the whole system where you're inserting the pillars into it and raising the elevation up, or you can take off the roof and build 1 to 2 stories on top of it. I'm currently working with a GC and builder right now who wants to come in and purchase these homes to do that, either for himself personally or through his company. And we have both renovation loans and fix and flip loans that can help them do that. So if you've got a flooded home listing and you want us to help market renovation loans on it, I'm happy to do that as well too. Amanda asked on buy a home while they have a home. Yeah, so if you want me to go through some of the ways on how we can qualify that buyer without a home sale contingency, that's the end of the renovation piece that I was going to talk about on there. So number one on the ways that we can avoid a home sale contingency is we qualify the buyer from a debt to income ratio perspective with both mortgages. Okay, so assuming they can qualify from a debt to income ratio with the existing mortgage and the new mortgage, and then they have enough funds to do a minimum down payment to still fit within that DTI. So let's say that they have enough to do 5% down on the new home purchase, right? So they have enough funds to do that already on their own without having the equity in the home. And they qualify from a debt to income ratio perspective, we move forward with the purchase, not contingent on selling their home. But you're like, well, I want to actually put $200,000 down, not just 5%. What do I do there? And that's where recasting the loan comes in. With a recast on a conventional loan only, this is not available on government loans. With Movement, our policy is that they make one monthly payment at that full 5% down monthly payment scenario, and their other home sells in the meantime, they can do a minimum lump sum principal payment of $10,000. Let's say in that case it's $200,000 in the scenario I gave. We will apply the $200,000 to principal and recalculate the mortgage payment as if they had put those funds down at closing and drop PMI. So I've done this multiple times in the last couple of years. It's a fantastic win for a client that they can get the home sold after they close on the purchase and then apply the funds towards principal after just one monthly payment and drop PMI and drop the monthly payment as if they had put the funds down at closing. That is the most common strategy I use on that case. Now, another way that we can handle that same scenario is that we pre-approve the buyer with the minimum funds they have in money market, savings, investments, 401k, whatever it is. And then we get the home listed immediately and do a simultaneous closing. And we shift the down payment amount from being 5% to the 20 to 30% or whatever it was by using the funds from the proceeds of the sale. This gets a little more stressful because what if the home doesn't sell? Well, then they have to be comfortable with using the funds from that other source. Let's say it was a retirement account. So I will pre-approve them and specifically state, if your home doesn't sell, I need to guarantee that you're okay with pulling the funds from this source, because we're not going to have a home sale contingency to back out with on there. And technically, from a financing contingency perspective, you qualify, right? So we don't want to use that as a let's see if it works type of thing. We want to use it with worst case scenario. This is what you're doing. You're comfortable with it. Cool. Let's do everything we can to get the home listed and sold prior to or simultaneously, and we can go. It's stressful, but I have done that in the past as well too. Client was okay with it. And thankfully, their home sold, quickly enough to be able to do that. So then the two other questions with that scenario is, what if the buyer doesn't have funds elsewhere? Or what if they don't qualify from a debt to income ratio with both perspectives? So we'll take number one, what if they don't have the funds available to do it? That's where we look at alternative means to either borrow against the equity in their home through a bridge loan or a HELOC. With a bridge loan, what we have to do is analyze what is the amount of equity that they have in the home and what is the limit that the bridge loan lender will allow us to draw from, and is that enough to be able to at least do a minimum down payment? And if the answer is yes, and they're comfortable with the terms of the bridge loan, then we proceed. We can do a standalone bridge loan and a standalone loan over here with two different products, or I have a combo bridge loan and end loan product that we can use as well too. Again, it's not always my favorite. I've never actually had to do one. I've usually been able to go with one of the other methods on it, but it is possible to do. The other one is a HELOC, where they can take out a line of credit on their existing home, and a HELOC is an acceptable source of down payment funds on that purchase. The key things to keep in mind here are that the credit union, bank, or even us, we do have a couple HELOC products on there. They, in most cases, will only do a HELOC on a primary residence that is not actively listed for sale. So if their home is already listed for sale and they want to do a HELOC, it's very likely that they will not get approved for that HELOC. So it has to be kind of a pre-planned thing that we're going to do. And they need to check with the bank or credit union or whoever does the HELOC is if there's going to be any penalty for paying off that loan, that line of credit in a certain amount of time. Back a few years ago, when I was in that situation, now about 6 years ago, the bank that I did the HELOC through made me pay back closing costs if I closed it within 12 months. So kind of just have to check on that as well too. But again, so long as it's enough to do a minimum down payment, the home sells later, we can still do the recast piece as well too. So again, that's the borrowing equity from the home process. Now, the other side of it is, what if they don't qualify from a debt to income ratio perspective? That's where that third-party product that I talked about, it's called Calque, CALQUE, and I can send you guys information on that as well too. What they will do is they will write basically a cash offer for the loan amount of the existing balance on the loan. They'll write a contingency-free cash offer on that home that will allow us to eliminate it from their debt to income ratio perspective. And this company then allows 6 months for the home to sell, and they charge a fee based on the loan amount on there. And they will also allow you to do a HELOC from another party. They're not a lender. They're not in the business to lend the money. They're just basically charging a fee to write a cash offer and giving the client 6 months to sell the home. Based on the information that they gave us, they said in 2024 they didn't end up buying any of the homes, and whatever amount you sell the home for, you sell it for. There's no limit to what you can sell the home for. They're only writing the cash offer for the payoff of the existing mortgage balance, if there's one or two mortgages on there. So that's another piece as well too. There is a fee associated with it. I want to say it's like 1.5% or 2%. I have to go back to my notes and look at it. So again, it's kind of bottom of the list in my perspective, because it's going to cost the buyer money, and there's going to be that anxiety of what happens if my home doesn't sell type of thing. But again, it is an option, and if it makes sense to the buyer, then we can go for it on there as well too. That may not have been exactly 5, Amanda, but those are the ways that we can work through that home sale contingency piece. I hope that was helpful. Anyone else have any questions they want to drop in the chat? Is there anything that I didn't touch on that you think would be helpful if we do one of these again in the future? All right. Well, that's all I've got for you guys today. Thank you so much for taking time out here to join us. I want to be a resource for you on anything that there is, so feel free to reach out to me 7 days a week. I'm here for you. I'm cheering you on. Have a great day.